Welcome back to Investing Talk Podcast.
Today we're diving into RCAT Holdings, and this is a really interesting one. It's a company that's gone through a pretty remarkable strategic transformation.
Yeah, remarkable is the word.
It used to be seen as, just another small cap player in the drone market, which is super volatile, but it's pivoted, and now it's really cementing itself as a key U.S. defense vendor.
And the data on that pivot is it's kind of stunning. We're talking about a stock whose preliminary Q4 2025 revenue surged, approximately 1,842% year over year.
Yeah, an 1,800% jump.
I mean, a figure like that, it's driven entirely by these big defense program wins, and it just signals a complete structural shift in their whole business model. They're moving away from that consumer volatility to secure government contracts.
That massive percentage, that's exactly why we need to dig into this.
Yeah.
You have to look past the usual metrics and really understand the why behind that kind of acceleration.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Okay, so let's unpack this phenomenal growth. The best place to start is, the fundamentals.
Right.
If we look at the trajectory, RCAT reported Q3 FY25 revenue of about $9.65 million. Now, that was already up 646% year over year.
And that's a critical inflection point, right? After years of R&D. And looking forward, their full year guidance for FY25 is projected between $38 and $41 million. If they hit that midpoint, that's a 153% increase from 2024. So this isn't some flash in the pan. It's an established trend, which I think is why analysts expect that revenue growth to just keep going. A CAGR over 90% through 2026.
But what's really fascinating is how they're financing all of this. Because if you just look at the raw numbers, the picture looks very, very different.
It does.
The trailing 12-month net loss is sitting around negative $90 million, and the operating margin is sharply negative, negative 182%.
Which looks terrifying if you're a value investor. I mean, that immediately screams high risk. So you really have to understand the context here.
Exactly. The bullish framing for this is that these heavy losses are, a temporary result of what the company calls investment-driven margin compression.
So they're choosing to do this.
They're choosing to do this. They're aggressively reinvesting pretty much all available cash into two main areas. First, capacity expansion. We know they're doubling their production space. And second, scaling up their key defense platforms.
Specifically, the Black Widow and the Blue Ops systems.
Right. So this massive cash burn, the institutional crowd sees it as a necessary evil. It's the capital expenditure you need to win and actually service these multi-year government contracts.
And you can actually measure that institutional belief. Ownership is up to, 37.97% now?
It is. They're signaling that they see this period of negative cash flow as a feature, not a bug. It's a bet on operational leverage kicking in once they finally reach that critical mass.
Which brings us to probably the most important question for any high-growth defense stock. What is the competitive moat? The drone space is crowded, so why RCAT?
I think we need to define that moat clearly, because it's almost entirely regulatory.
Okay, so explain that.
Right. RCAT's core advantage is its status as an NDAA-compliant Blue UAS supplier. And that's not just some marketing term. It's a government-mandated regulatory shield.
So functionally, what does being on that Blue UAS list actually do for them? I mean, why is that regulatory status better than just having the best tech?
It means deep, vetted integration into the DoD supply chain. It means your systems meet these incredibly strict cybersecurity and supply chain standards. And, critically, this status actively locks out huge foreign competitors.
Like DJI and Autel.
Exactly. They are facing more and more restrictions, even bans, from the FCC. So they simply can't compete for these specific U.S. government contracts.
So it's not just about winning on the tech, it's about winning on policy. The government is basically restricting the playing field for them.
It is. And RCAT is now deeply integrated into these key programs. The Black Widow SRR platform was specifically selected by the U.S. Army for its short-range reconnaissance program.
And that SRR selection is strategically huge. It means they've secured a defined requirement, which should translate into years of high visibility, follow-on orders.
And on top of that, the company is included in the massive $1 billion DoD drone dominance program. These are multi-year demand levers that give you revenue visibility that a typical growth stock just doesn't have.
Okay, that gives us the strong fundamental story. High growth, visible pipeline, all driven by this policy-mandated protection. Now let's pivot to the charts and let's look at the tape. Policy and contracts are one thing, but how is the market actually reacting?
Well, the reaction is dramatic. Volatility is the word for this stock. Over the last 3 years, even with some pretty big pullbacks, the stock has surged about 971%. It's a high beta name that just moves violently when news drops.
Yeah, the recent action really highlights that. Shares just ripped higher in early 2026, almost wiping out all the prior losses. You see these single-day surges of 10, 13%, and they're almost always tied directly to a contract or some regulatory news. It's highly reactive.
And this momentum is now getting noticed. AI-driven technical analysis is highlighting what they're calling an exceptional risk-reward setup, targeting a 35.3% gain.
Which tells you that big trading desks are setting clear upside targets. It suggests that a consolidation period might be ending and, fresh momentum is building.
So that brings up the question,
Mm-hmm.
are the big funds actually buying into this momentum, or is this just retail speculation? Let's talk about the institutional flow.
Good idea.
Well, the signals really point toward definite accumulation. Institutional inflows show a high extra-large investor ratio, about 54.19%. So they are clearly adding to their positions, and they're doing it aggressively.
So they're accepting the current financial risk because they believe in that future dominance story.
And the options market backs that up, which is often a cleaner read on what the sophisticated money is doing. We saw huge interest. 36,890 call options traded in a single session. That's 58% above the average volume. That kind of flow is crucial. It confirms that institutions are positioning for a big move up, maybe targeting those prior highs. The money flow is telling you they're willing to stomach the negative earnings because the tailwinds are just too powerful to ignore right now.
Okay, so if the technical tape looks this bullish, how is the street, the analysts who have to justify these price targets, how are they interpreting this mix of explosive growth and these massive losses? Let's shift over to sentiment and market perception.
The consensus is overwhelmingly bullish. The combined rating across 4 brokerages is a strong buy. And maybe more importantly, there are 0 sell ratings on the street.
No sellers.
None. And the quantitative mood confirms this. It shows a strong bullish bias with a weighted average sentiment score of about 0.42.
And the price targets absolutely reflect that conviction. Consensus 12-month targets are ranging from what? $12.50 to $16. That implies anywhere from 20 to 80% upside from where it's been trading.
Right, and we saw Needham, who is a key voice in this space, they specifically upgraded their target to $16.
So what's driving that? What's driving that high conviction?
It's the clarity of the tailwinds. We mentioned it before, but that FCC decision to ban foreign drones, that was a huge structural event. It drove the stock up 12–13% immediately because it just crystallized the entire opportunity.
Right.
You pair that with the U.S. Army's Black Widow contract, and that's a foundational thesis for pretty much everyone.
Okay, but we do have to talk about the noise. Where you have this kind of volatility and defense contracting, you're always going to have a layer of retail speculation and rumor.
That's right. And we should explicitly address the unconfirmed stuff. The company's alignment with policy led to some speculation linking their drones, like the Black Widow, to potential U.S. military action in volatile regions like Venezuela. And that chatter definitely drove a sharp price spike.
And we have to stress, those connections are explicitly unconfirmed speculation. But they do highlight a really important concept, which is the high optionality baked into this stock. This isn't just about the current contracts. The market is pricing in the potential for these non-linear, unpredictable contract boosts that are linked to global conflicts. That geopolitical factor gives the stock a risk premium, sure, but also huge leverage on global events.
That's a great point. So the market is pricing in that potential, not just the current sales. But you always play the skeptic, so we need a robust bear case here. Let's pivot now to the risks and the hurdles that RCAT is facing, especially with that $90 million loss.
My job is pretty easy here because a $90 million TTM net loss combined with persistent negative free cash flow, that creates a very, very real funding risk. They have relied on equity raises to finance this growth, which means a high dilution risk for any existing shareholders.
And that cost is visible in the valuation, too. It is significantly stretched. The stock's trading at roughly 5.1x price to book.
Compared to the industry average of 2.4x.
Yeah.
So let's put that in perspective for you listening. You're basically paying $5 for every $1 of RCAT's physical assets. That's a steep price. You're betting their IP, their regulatory status, and their contracts are worth 4 times the company's book value. So why should anyone tolerate that?
Well, the argument is that the downside is cushioned by 2 things. That sustained institutional support, they're still buying, and those regulatory tailwinds you just can't replicate. The high valuation is justified by the 153% growth and, crucially, that multi-year demand visibility from the billion-dollar drone dominance program.
So the hope is that scaling up fixes the losses.
The expectation is that the scaling effort will eventually lead to economies of scale and operational leverage that will, significantly reduce those losses over time.
But aggressive reinvestment requires flawless execution. I mean, scaling from a small cap to handling multi-year DoD programs is incredibly hard. That is a huge execution risk.
It is. They have to execute flawlessly on scaling up production for both the Black Widow and the Teal-2, while also managing all these new, complex internal structures. And they have to overcome some prior hiccups, too.
Like that documented 6 to 7 week delivery delay in the Black Widow program. That triggers some pretty cautious analyst reports. A delay like that, even if it's temporary, can crush confidence in a stock that's valued entirely on future growth.
And that's the tightrope they're walking. The market is accepting that these losses are the cost of securing that first-mover advantage and market share in the blue UAS space. The risk is that if execution falters, the market could quickly pull back from that 5.1x premium.
So it all comes down to execution.
But the visibility from that billion-dollar program suggests management has a clear path and, frankly, a massive incentive to hit their production targets. The scale should really start to reduce that margin compression by fiscal year 26.
Which raises the essential question. Does the scale of the opportunity here outweigh the scale of the financial losses and the execution risk?
I think that brings us right to our verdict. Let's synthesize all of this. The policy moat, the technicals, the analyst conviction, and the risk into a final investment thesis.
Okay. Based on the weighted analysis of all the factors we've discussed, the highest consensus score we found for RCAT is a very strong 8.5 out of 10.
And to summarize the thesis, RCAT Holdings is it's uniquely positioned to capture massive market share in the U.S. defense drone sector. And that's because of these structural advantages, specifically the Blue List certification and the FCC bans on foreign competitors that can't be replicated.
And critically, the institutional market right now is prioritizing the Black Widow SRR production ramp and that triple-digit revenue growth over the current and hopefully temporary net losses. It's a bet on policy and execution success.
So what does this all mean for you, the investor? This is best categorized as an asymmetric upside play. It's for those of you who are willing to tolerate the high volatility. You're betting on the company successfully making that transition from a development stage entity to a high-volume, reliable defense supplier.
So the optimal strategy here is to view this as a 12 to 24-month high-conviction growth position. You really want to hold through fiscal year 26 to capture the full impact of that scale-up and the operational leverage that should come with it.
That said, there will be tactical swing trade opportunities. They'll pop up around specific events, like the next earnings report, which is expected mid-February 2026. Management commentary on guidance and backlog around those events will provide really key entry or exit points.
The final takeaway for you to think about is this. In an era where geopolitical risk is rising and secure, domestic defense tech is a national priority. How much is a certified NDAA-compliant company truly worth, even if it's burning cash today to solidify that top spot?
The market is clearly suggesting the answer is substantial. It's viewing RCAT more as an emerging defense staple than a traditional tech growth stock.
We covered a ton of ground on RCAT today. If you found this discussion valuable, please make sure you hit that subscribe button, like, and comment on this video to support the show. We'll see you next time.